areas of the commodities sector at present do you think presents the greatest value proposition, and how are you positioning yourself to capitalize? Lobo, I'll start with you.
I'm going to have to go with copper. That's been my top call for 2025. And people have been wrongly congratulating me on that because copper hit an all-time high earlier this year, but not for the reasons that I gave. So maybe you should stop listening to me then. But I think all those reasons I gave are still in front of us, and going into that from a higher cost base or a price level, I think that just adds to the upside. And the thing that I like about, I'm bullish on many things. I could, other metals and minerals are high on my list. But the thing that I like about copper is that it really is straight. The structural supply constraints here are so real, so big. That pipeline is so close to dry for years and decades to come. It's just an extremely strong thesis. And I think we're getting to that push comes to shove moment. My only concern is in the very near term, we still have plenty of trade war issues, actual war issues, Trump shock ahead to deal with, and Dr. Copper is economically sensitive. So I think there's potential for near-term weakness, which I would absolutely see as a gift from Mr. Market, a buying opportunity, and I am saving up cash for that.
And really quickly before we move on, why did copper hit all-time highs, and why did that not align with
for the wrong reasons? Trump didn't even announce a copper tariff. He announced, he signed an executive order. We're going to look at copper. We're going to study it. Oh, great. You remember when they studied uranium? That took years, and then they did bupkis. Sorry, but the fact is it was actually Biden that implemented the Trump study group idea of uranium, of establishing that uranium reserve, and funded it, or started it anyway. So, a study group doesn't excite me. And maybe it's a coincidence, but that's all that really happened in the market at that time. What's happening now, I think, is more real. It's got more of my attention. I'm still worried about Dr. Copper in the nearest term, but when the LME stocks go, way down, and China's having to, trouble getting its smelters to work right. They're very excited because they just got to zero smelting charges. That tells you something about the market. So I'm really, really very keen, and I don't claim to be able to time the market. I just have this feeling, though, that the time to buy is in front of us rather than behind us. If I'm wrong, I'll still have years, I think, and decades to make money on this trade. If you're very patient and you can handle the kind of drawdowns that have resulted in Rick having less hair than me at this time on the way. Rick will tell you all of my big wins have had 50% drawdowns on the way. If you can handle that, and you think copper is likely to, the bottom is behind us, then don't wait for me. Go ahead. I think that is so solid that I would go ahead. But it's Dr. Copper. I just can't get it out of my head that the other shoe is yet to drop on the retooling of the American economy that the president is trying to ram through, and that will have consequences that I think will create a buying opportunity.
And Rick, what are you watching the most right now when it comes to the commodities sector? What do you think is presenting the greatest value proposition?
The answer to the question is really a function of the investor's time frame. If the investor's time frame is short, I think that the gold stocks and the silver stocks have to catch up to the gold price and the silver price. I think we are in a conventional precious metals bull market, which is led by the metal. After the metal, the best of the best follow, and then the best of the rest follow. So if the investor is asking me the question from the point of view of a 1-year time frame, I think the gold and the silver equities are likely the place to be. I'm not positioning there because I'm positioned. I have this paper coming out of every available orifice, horrible image, but that's the way it is. I agree a lot with Lobo with regards to copper. I like the copper business because there's any number of copper mines in the world that make $2 or $3 million a day. And I have a fondness for big deposits as opposed to small deposits. The copper business has treated me extraordinarily well for 40 years, so I'm predisposed to it. I'm a bit more cautious than Lobo, which is unusual, in the near term about the economy. I'm not an economist, but I note that the oil price falls even on flat oil production. That tells me something about near-term demand in the economy, not what people are looking to in the future. But I would agree with Lobo that to the extent that we see copper weakness as a consequence of the global economy, that we view this as a gift. If you look out further, for every reason in the world needs more types of power of all types. And copper is how you get it. Well, it's how you generate it. It's how you get it from where it is to where it's needed. And it's how you use it. There's 1 billion people on Earth with no access to primary electricity. Those are all copper buyers, whether they know it or not. And we all want to use more energy. It makes our life better. My own particular thesis is that I'm a commodity agnostic. I like great big deposits, tier 1 deposits, sort of $20 billion in net present value at today's prices in recoverable reserves and resources. And I don't care about the commodity. What that means is that I'm looking at tier 1 deposits in out-of-favor countries in out-of-favor commodities. Things like rare earths in Brazil, things like rutile and graphite in Zambia. 6 months ago, before it became popular again, platinum and palladium in Brazil. I have a huge fondness for great big deposits in out-of-favor commodities in out-of-favor countries where the market ignores it. The idea that there is a deposit that could in 5 years be worth $2 or $3 billion that has a market cap of $50 or $60 million today is particularly seductive to me because I've enjoyed it so often in the past.
Good questions, but let me jump in on this gift point because I think this is really important. It's something that Rick and I have both seen in our careers. And we've had a recent example, and that was in the uranium space, another area that I know Rick and I agree on. When uranium sort of bottomed out recently, and the stocks held up because the uranium story is so strong. Everybody sees it. The demand case is so high. Even skeptics have so the uranium stocks were kind of holding up, even though spot uranium was going down. And then that DeepSeek thing came out of China, and everybody's, oh my gosh, AI is not going to need all this energy, and uranium stocks cratered. That was absolutely a gift. I mean, it was a sell-off for completely the wrong reason. Uranium went up to 80, 100, before the AI craze kicked into high gear. The AI story was never the reason for owning uranium stocks. It became an purely optional bolt-on tailwind at some point, and its disappearance made no difference, none, zero whatsoever to the investment thesis for this still necessary, no substitution, sorry thorium fans, not anytime soon, right? You've got to have it. Or as Rick says, the lights will go out in large swaths of the world, and it goes on sale for completely hype-driven wrong reasons. An absolute gift.
People often ask me, Rick, what's the next big thing? Or more precisely, what's the next big thing that's still cheap, underappreciated, unloved, and ready to go vertical? And I give them the same answer I've given for over 4 decades. There are always opportunities, but most investors don't like them when they're cheap. They like them when they're fashionable. So let's talk about the unfashionable. Let's talk about the places where real wealth is created. Now we're in a gold bull market. That much should be obvious to anyone paying attention. You've got gold flirting with all-time highs, central banks gorging themselves on physical reserves like kids at a candy store, and yet the mining equities still lagging. This is the kind of dislocation that only happens when the market is run by emotion and not by math. And if you're an investor, that dislocation should make you salivate, not hesitate. Let's take the GDX, the Gold Miners ETF. In 2024, people were writing eulogies for it. Broken chart, broken trust, broken thesis. That was the narrative. I argued otherwise, and I wasn't alone. My friend and former protege, Lobo Tigre, pushed back as well. You see, many investors look at a rising gold price and assume the mining stocks should follow in lockstep. But as I've said before, and as history confirms, mining companies have a tendency to snatch defeat from the jaws of victory. In the last big gold bull, gold went up 7-fold, and gold miners managed to turn that into negative free cash flow. That's not incompetence, that's talent. But this time is different. Not in the overused ECNBC sense, but in the operational sense. The better-run companies, Agnico Eagle for instance, are not only producing gold, but producing free cash flow, paying down debt, and in some cases returning capital to shareholders. That's a trifecta that the gold bugs of the early 2000s could only dream of, and yet the market barely cares. Why? Because investors have a memory, and their most recent memory is of gold miners as financial black holes. But gold miners are finally running with the ball, not fumbling it. The real risk is not that they underperform again, but that investors miss the re-rating because they're too anchored in the past. Now let's shift gears to the real story underneath all of this, the dollar. The US dollar, the world's reserve currency is in a long-term decline, not necessarily relative to other fiat currencies, but in absolute terms. We've had a 75% erosion in purchasing power over the last several decades. That's not theoretical. That's your grocery bill. That's the price of a home. That's why I say gold isn't going up. Currencies are going down. Doug Casey once referred to the dollar as the prettiest mare at the slaughterhouse, a perfect analogy. In a fiat world, the US dollar is the best of a bad lot. But let's not confuse relative strength with absolute safety. The US government has over $34 trillion in debt, a structurally broken entitlement system, and no political appetite to change any of it. The only politically viable solution is inflation, an invisible tax on savers and an unspoken gift to debtors. And that's the real bullish case for gold, and for silver, and even for platinum group metals. The value of these metals doesn't rise because they become more useful. It rises because what we measure them in becomes less trustworthy. Let's pivot to silver. Silver's behavior in this cycle has been classic. It lagged gold, got written off by the generalists, and then, boom, it popped. We saw it run up to $32.70 in May of 2024, come back down, then revisit $35 later in the year. It sold off again, violently into April of 2025, hitting $27.50, and then rebounded just as fast, now trading around $37. This kind of price action is not only technically bullish, it's emotionally scarring. And that's what creates opportunity. The weak hands get shaken out, the chart watchers get whiplash, and the value investors quietly accumulate. My friend Michael Oliver, who does excellent momentum-based analysis, pointed out that during all of this erratic sideways action, momentum was quietly building a base, a structure. In June, it broke out of that channel. And that, my friends, is how these moves start. Not with a bang, but with a twitch, then a jolt, then a stampede. Could silver go back to its old idiot highs of $50? Sure, but that's just the warm-up act. Adjusted for inflation, $50 in 1980 is closer to $300 today. So don't anchor your expectations to arbitrary round numbers. That's what tourists do. Real investors look at fundamentals, momentum, and capital flows. And silver structurally is poised to outperform gold in the next leg of this bull market.
The thesis that the gold stocks were broken is one that was really a 2024 story. And I wrote about it just over a year ago, arguing that they weren't broken, but that as my mentor, Rick Rule, taught us so well, the gold producers in the last big gold bull market managed to turn a sevenfold increase in the underlying commodity into an increase in negative free cash flow. And I went and charted that. It's true. So the intelligent investor, assuming there are 2 or 3 left still alive, it wouldn't be wrong for them to hesitate before saying, oh, gee, gold's up, gold stocks should go up. The last time, they turned it into greater negative free cash flow. Why would you buy that business? Or as my other mentor, Doug Casey, says, it's a crappy choo-choo train 19th century industry. Why would you invest in that today if your most recent experience with it is a dramatic underperformance? So flash forward to this year, and not only do we have the higher gold dollar exchange rate. I don't like to call it the gold price because in my mind, gold is money. So it's a Forex question. The higher gold dollar exchange rate, it's not just that has pushed up the miners. The miners have actually started delivering. Agnico, as you mentioned, known for excellence of operations, it actually was outperforming even last year. And the other ones that have problems, not so much. And that kept the GDX underperforming. Well, this year, even last year's underperformers are benefiting from the margins, and some of them are actually getting their act together. And so, it makes sense. The business is actually delivering, and so those people who previously said, "Well, the gold miners, they flubbed it last time. They dropped the ball." Well, this time they're actually running with the ball. There's a rational basis for saying that. Well, now it makes sense. And then, of course, the food chain, the trickle-down theory, that actually does work in the mining space. We've seen this repeatedly. So I will push back a little bit on my mentor here and say that the obviously better companies have responded with gusto here. So it's really difficult for me to look the audience in the eye and say, yeah, never mind $3,300, $3,400 gold in all-time highs, not just 52-week highs, but all-time all-time highs in a stock like Agnico or something like that, just buy it. It'll be fine. There is opportunity for correction. And the idea is to buy low, sell high, not to buy high and hope to heck to sell even higher. So as much as I love a company like Agnico, I wouldn't buy that today at an all-time high or very near to that. I would look for something that is legitimately still overlooked. And this requires due diligence. This is a stock picker's market now, is basically what I'm saying. I wouldn't buy an ETF. I wouldn't buy the GDX or the misnamed GDXJ. I would look for something that is legitimately bringing value to the market, which hasn't caught on yet. And those do exist. They're out there. But there are ones that you can't say, oh, it's cheap, so that's an overlooked gem. No, there are stocks that are cheap and they deserve to be cheap, right? Lifestyle companies and that sort of thing. So again, caveat emptor, buyer beware. This is a stock picker's market. But if you're willing to do a little work, and hey, if you want to make money, you should be willing to do a little bit of work. Maybe a lot of work. I do think that there's still, I'm agreeing with Rick, there's still opportunities in the gold and silver stocks, but I do think it requires effort here, no dart throwing.
Well, I would respond to Lobo by saying it's always required effort. And what he says about the sector as a whole couldn't be more true. There's probably 1,000 public companies worldwide that purport to be in the gold space, but most of them only have gold as a component of the name on the share certificate. If a commodity rises that you have none of, it shouldn't impact your basic values. And the great majority of the purported gold mining stocks will ultimately return to their intrinsic value.
Let's go ahead and finish this the way I promised, with candor, some history, and a firm hand on the rudder, because if you're navigating the commodity sector in 2025, you're going to need all three. We've talked about gold and silver, the momentum shift underway, and the asymmetries in the mining equities that few are truly exploiting. But I'd be doing you a disservice if I didn't zoom out and talk about where the broader commodity complex is setting up. Because friends, while precious metals are the heartbeat, copper is quickly becoming the backbone of this next chapter. Now my friend Lobo Tigre has been beating the copper drum loudly, and rightly so. But I'll say what he's too modest to, he's early. Not just in the call, but in understanding the underlying forces that are going to make copper one of the most strategically critical materials of the coming decade. In fact, we're already late to recognizing what's obvious to the people who actually build things. The green revolution, the AI revolution, the electric revolution, all run on copper. You don't get solar panels, wind turbines, EVs, data centers, or power grids without a whole lot of copper. And here's the kicker. There is no scalable substitute. Aluminum isn't going to cut it. Silver's too expensive. Graphene? Come back to me in a decade. If you want to generate electricity, transmit it, and use it efficiently, especially over long distances, there is one metal and one metal only, and the world is running out of it. We're not talking about hypothetical shortages. We're talking about real physical bottlenecks in the copper development pipeline. According to S&P Global, the copper market faces a supply gap of 10 million tons per year by 2035. That's not an alarmist blog post. That's from the institutional corner. Glencore, BHP, even Goldman Sachs have echoed similar numbers. And yet copper prices haven't fully priced in the structural shortfall ahead. Why? Because markets are myopic. They're staring at China's smelter margins, they're watching macro volatility, and they're terrified of political headlines. Rather than looking at 5 years out, when the world is going to beg for new supply and find almost nothing shovel-ready. Now, I'm often accused of being too focused on size. Rick only likes big deposits. Guilty as charged. Why? Because they work. Because if you find something that could generate $20 billion in net present value at today's copper price, and it's trading for $100 million market cap, that's not just speculation. That's arithmetic. And I like arithmetic more than I like narratives. There's a reason I've been sniffing around in places like Zambia, Brazil, and even Mongolia. Yes, they're politically challenging. Yes, they come with risk. But guess what? That's why they're cheap. And as I've said before, real wealth is built by being early in a place or commodity that people are still laughing at. Then you wait for them to stop laughing. Then you wait for them to start paying you to buy it off your hands. And the uranium story? My God, it's the most mispriced geopolitical security asset on the planet. There is no carbon-neutral world without nuclear. Full stop. You can't pretend otherwise unless you're selling wind credits or solar panels. And even the most stubborn anti-nuclear policymakers are waking up to this. Remember when Germany shut down its last reactor in 2023, then immediately turned around and started burning coal? Yeah, how'd that work out? CO2 emissions spiked, energy costs soared, and now guess what? Even the EU is reluctantly labeling nuclear as green. Meanwhile, Japan is quietly rebooting its fleet, South Korea never really shut down its program, and China is building reactors like it's laying bricks. So yes, uranium is still early. We had the first leg of the bull market from 2020 to 2022, a healthy pause, and then another push. But we haven't even seen the ETF money come in yet. The Sprott Physical Uranium Trust is still absorbing material from the spot market, and we're just beginning to see the generalists circle around the equities. Now let me say this. If you waited for uranium to become fashionable again, congratulations, you made it back to 2010. And if you think the trade is over because of a pullback, I suggest you reread the thesis. When something necessary goes on sale because of short-term noise, like a Chinese AI tweet or a study group announcement out of DC, you don't panic, you thank the market, you light a candle, because that's your gift. Let me give you a real-world analogy. Back when I was first building out my uranium positions in the early 2000s, it was about as fashionable as vinyl records. Most of the developers couldn't raise a dime. Nobody cared. And then the price of uranium went from $10 to $135 in a heartbeat. Companies that were valued at $20 million went to $1 billion. Now, am I promising a 50x return on everything? Number, that's not how this works. But I am saying that when demand is structural and supply is broken and capital hasn't caught on yet, your job is to move. Not to wait for CNBC to bless it, not to wait for a newsletter headline, but to act like an intelligent contrarian. And let's address something else that trips people up, the idea of volatility. People love to talk about upside. They hate talking about 50% drawdowns. But every single one of my biggest winners, every single one, has seen 50% drawdowns on the way to success. Why? Because that's how asymmetry works. If it were safe, it wouldn't be cheap. If it were easy, it wouldn't be 20 times. That's not a flaw in the system. That is the system. Now, here's what I want you to take away from this whole discussion. If your time frame is 1 year, look at gold and silver equities. The metal prices have already moved. The equities haven't fully caught up. They're generating margins. They're going to re-rate. If your time frame is 3 years, look at copper. We're entering the bottleneck. It's not a question of if we run out of mine-ready supply. It's a question of how loud the panic gets when we do. If your time frame is 5 years or more, look at uranium. The fundamentals are baked in. The only thing missing is widespread capital. And when that capital arrives, the repricing will not be gentle. And if you're like me, if you're willing to go way down the value chain to sift through the underloved, the overlooked, and the misunderstood, then this is a target-rich environment, but only if you do the work. No dart throwing, no hope trades, no it's cheap, so it must be good logic. Remember, there are two kinds of cheap, temporarily cheap and terminally cheap. Your job is to know the difference. Before we wrap, I want to share something that stuck with me. Years ago, a young investor at a conference asked me what my secret was. I said, there's no secret. Just patience, pain tolerance, and spreadsheets. That's still true. But I'd add one more thing. Clarity. Clarity about what you own, why you own it, and what it's worth. If you're buying a copper developer in an emerging market, don't pretend it's a treasury bond. It's not. It's a call option on global electrification with all the political baggage that comes with it. But if you've done your homework, that baggage is where the discount comes from. If you're buying a uranium producer with a clean balance sheet, don't sell it just because Bloomberg says AI doesn't need power. That's noise. Block it out, stay focused. And if you're holding gold majors that are throwing off cash flow at 2,400 gold, just remember they're still priced for 1,800. That's the mispricing. That's your margin of safety. I'll leave you with this. The commodity sector in 2025 isn't a perfect setup, but it's a profound one. We are entering an era where real assets will matter again, where scarcity meets policy failure, where capital finally stops chasing dreams and starts chasing reality. And those of us who've been through this before, we're not surprised, we're prepared. Be early, be rational, be bold, and above all, do the work. Because if you don't, somebody else will.
Stay informed about the latest developments shaping the precious metals markets with regular updates from the Finance Daily team. Not only that, but as a subscriber, you'll also receive timely silver and gold price notifications and early access to groundbreaking news unavailable to the general public. Join our free gold and silver newsletter today, link in the description.